Um,
Sorry about that.
awesome. Actually change my name on here. I want to put my cell phone so that you got it too. So what'd you do? What are you doing? Are you working another job right now too?
No, kind of, sort of, no. But
Okay.
I'm a photographer, videographer, so that's
nice.
that has been my main industry for the past 20 something years in some way, shape, or form. But I left a full-time job in 2017 and pretty much concentrated on all my freelance efforts, and then got my license for real estate in October of 2020. So
That's awesome. Are you people or objects mostly when it comes to photography?
mostly people. I have done some listing photography. I did a listing photos on Monday. Done about 5 or 6 listing, so objects, but
Nice.
mostly events, weddings and such, portraits.
That's awesome. So, and you're new to real estate right now, right?
Yeah, it's my first year. Actually going into my second year.
And have you closed anything?
Yes.
Awesome. What, so I guess what I would love to do, since it's just us, right? Like I'll give you an idea of what I typically do, but I also would love to just answer any specific mortgage related questions you have. Because I think it would be, good for us to kind of, hash out anything that you've got relating to loans that you want to discuss. So
Okay.
let me share my screen here. I did one of these before. We had a good turnout, but I worked in the legacy classroom. I couldn't figure out how to work the computer or share my screen. So I'm happy I'm working out of my office here and able to do that. So let me give you a background about myself, and let me also kind of, and this will be impromptu, obviously, but let me give you a background about myself, about our company, and kind of how we go about everything. So our company, Primary Residential Mortgages, in every state but New York. We do $13+ billion in business. Okay. I'm licensed in Maryland, Pennsylvania, Delaware, DC, working on South Carolina and Florida. But obviously we'd most likely be just doing Florida, or most likely be doing Maryland and, and maybe the surrounding, states. So I've been in the business 16 years. Before getting to the business, I bought my first house. So I bought my first house 17 years ago. And when I bought my first house, the mortgage guy I was working with said, sign there, date there, date there, sign there, date there, date there, sign there. And in doing so, he told me payment was going to be X. When I went ahead and, got my closing disclosure, at the time it was the HUD-1, payment was Y, which was a lot more than X. And at that time I was pigeonholed into buying a house, and I hated the entire process. So I created this little booklet on the premise of the horrible experience I went through and how to make it easier for others. So I'm going to go through this little home buying booklet and share it with you. And then obviously I want you to reach out with any questions as we progress here. So when we're buying a home, this is a little background about me, which I could email you, this booklet and all the stuff that I'm going to share with you, background about our company. But really, when you're getting a loan, there's 3 things that we are focused on when getting a mortgage, right? And I always call it Mortgage 101. So what goes into getting a mortgage is a borrower's credit, loan to value ratio, and debt to total income ratio. When we're looking at somebody's credit, we're looking at their credit score. And in addition to their credit score, we're also looking at their total monthly debts. So when we pull somebody's credit score, the ideal situation is a 760 or greater credit score. The lowest credit score that we typically want to see is 580, but 760 is the ideal situation. When we go ahead and pull somebody's credit, we're also looking at their monthly debts, right? So we're looking at their credit cards, their student loans, their car payments. Their cell phone bill, their bar tab, et cetera, will not show up on their credit report, okay? The only thing that will show up on their credit report is their liabilities that are required to keep their credit score intact. So you have your credit is the first thing. The second thing that we look at is what's called loan to value ratio. LTV is the acronym that we use. LTV is calculated by taking your loan amount and dividing it by your purchase price. So if you're buying a $100,000 house and you're borrowing $80,000, then your loan to value ratio would be 80%. So your down payment would be 20%.
Mhm.
I always tell people the first and second part, they have complete control over, the credit and loan to value ratio. The third part, which is the monthly debt, right? Or sorry, the debt to total income ratio is what we have control over when I say you're pre-approved or not. So we take your total monthly debt, your credit cards, your student loans, your car payments, plus your new mortgage payment, and we divide it by your gross monthly income. And we get what's called your DTI. Your debt to total income ratio is calculated by doing that. And we don't want to see your debt to total income ratio exceed 45%. So if somebody makes, let's just use, let's say somebody makes $120,000 a year, good income, right? And that's $10,000 a month. We don't want to see their total debt, right? Their credit cards, their student loans, their car payment, and their mortgage payment exceed $4,500 a month. That's 45% of their gross monthly income.
Mhm.
So this is a good, depending on how close you get with a client, this is a really good, easy calculation to be like, hey, this is what you shouldn't exceed in all your debt capacity. Because a lot of people will reach out to you and ask you, like, where do you think I should, what do you think the max I could qualify for? And if they're comfortable telling you what they make a month, then you could calculate that pretty easily. Now, when qualifying for or getting a mortgage, there's 4 types of mortgages. There's USDA, VA, FHA, and conventional. Are you, familiar with the different, FHA, VA, conventional, USDA products?
I've dealt with some VAs and FHAs thus far.
Okay.
And some conventionals.
Awesome. So a VA is an awesome product because it's 100% financing. Obviously, it only can be used for a veteran, and there's no monthly mortgage insurance, and the seller could pay all the closing costs. So that is the best product out there. A FHA is an awesome product. It's a really good loan too, and only requires that the borrower put down 3.5%. And the seller does have the ability to contribute up to 6% of the sales price towards your closing cost.
Okay.
It's a government insured loan. So what I mean by that is it doesn't matter. So you're going to have mortgage insurance. Okay. And mortgage insurance is, with an FHA loan, there's something called upfront mortgage insurance and monthly mortgage insurance.
Mm-hmm.
Mortgage insurance will never go away on an FHA loan. Okay, on a monthly basis. The upfront mortgage insurance is paid out in a lump sum. Okay, the monthly mortgage insurance is 0.85% of the loan amount divided by 12 every single month, and that will never ever go away. And it doesn't matter your credit score. The higher or lower credit score does not matter. Now, if you go with a conventional loan, you will have mortgage insurance unless you put down 20%.
Mm-hmm.
But your mortgage insurance is impacted by how much money you're putting down and how high or low your credit score is. So the higher the credit score and the more money down, the cheaper your mortgage insurance will be with a conventional loan versus a, FHA loan. The other big differences with a conventional loan is, again, you can put down 3% on a conventional loan as owner occupied only. Okay. And you can only ask for 3% of the sales price towards closing cost on a conventional product. Are you familiar with all this? I don't want to kind of go deep on something that you might be familiar with.
Yeah, semi, but it's good to hear it again.
A little refresher. What are so any particular questions as it relates to FHA or conventional, specifically to their products?
No.
Okay, cool. So, look, at the end of the day, a conventional product is a better long-term loan because mortgage insurance will go away if you happen to have it.
Mm-hmm.
But FHA is an awesome loan to get into for the short term. Okay. And then eventually, 1 to 5 years down the road, you want to consider refinancing out of FHA into a conventional conforming product. So, and you will get a better interest rate and sometimes cheaper mortgage insurance with an FHA loan if you have lower credit score. If you have higher credit score and some money to put down, conventional is a better product because the mortgage insurance will be cheaper on a conventional loan if you have a higher credit score than if you had a lower credit score. So again, it all kind of depends on the individual situation. How many times have you dealt with a buyer and been like, oh yeah, by the way, so you got your like 5% to put down, but do you have the other money for closing costs? And they're like, scratch their head. Like, what are you talking about?
Quite often.
Yeah. So closing costs is the part where most people are just blown away with. And I break closing costs down into 4 different sections here. You have lender and realtor fees, title company fees, state fees, and your escrows. So our company charges $16.45. That's our transactional cost. On average, the appraisal is around $575. That's the only out-of-pocket expense that the borrower has to pay before closing. And I would say the average realtor admin fee in the state of Maryland is $495. Okay. So that is the set fees that are, lender and realtor specific. A title company, obviously there to verify you're buying the house from the rightful owner, their attorney charges. And then you also have lenders and title and owner's title insurance. So lenders title insurance on average is about 0.26% of the loan amount. And owner's title insurance is on average about 0.2% of the purchase price. Okay. Owner's title insurance, is optional to be waived, but obviously it's silly to do that, especially when you're buying a 100-year-old house. Lender's title insurance is required by every single lender in the United States of America. And that's to protect us, God forbid the title company messed up. Transfer tax, Baltimore City is the highest county in all of Maryland to buy a house in. And the transfer tax is around 3% of the sales price, but it's typically split between buyer and seller in a resale transaction, all this stuff that you probably know. So instead of paying 3% in Baltimore City, you're paying 1.5%. And then your escrows, your taxes and insurance, your escrows, when a borrower is like, hey, I want my payment to not exceed $1,500 a month. Typically they're talking about their principal, interest, taxes, and insurance payment. Your taxes and insurance payment are your escrows. And your escrows are, at the time of settlement, we're going to collect typically 10 months worth of taxes because we need to pre-fund that escrow account. And then we're going to collect about 14 months of homeowners insurance, 1 year up front and 2 to 3 months in addition to that. On average, if you're buying a house in Baltimore City that is $250,000 plus, right, or greater than $250,000, then it's around 4.5% of the sales price that is going to encompass all these closing costs. In general, in Baltimore City or Baltimore County, it's around 4 to 4.125. Okay. And all of that is, encompasses every one of these fees. One big thing, why Baltimore City is higher than Baltimore County is the transfer taxes right here. And in addition to that, the property taxes tend to be higher in Baltimore City than they are in, say, in Baltimore County, which is if you're collecting for 10 months of property taxes at $200 a month, that's only $2,000. But if you're collecting for 10 months of property taxes at $400 a month, then that's $4,000, which increases the closing cost. So when a borrower asks you real quick, hey, I'm buying a $300,000 house in Baltimore County, what would you say the estimated closing costs are? $12,000, right? But Mr. Borrower, we can negotiate and see if the seller would be willing to pay some, if not all, of the closing cost.
Okay, so back up a little bit. So in Baltimore City, a $250,000 home would be about 4.5% in closing costs.
Correct.
And then in Baltimore County, the same home would be
around, let's say 4.125. So just say 4, or we can say 4% just for easy numbers. But yeah,
okay.
yeah. And that's just an easy thing for you to split off with a buyer, because if somebody comes to you and says, oh man, I got 5% to put down, say, that's awesome. But we also need to consider closing costs. And when they say, well, what do you think closing costs are going to be? That's just a very quick number for you to spit out. And honestly, 99% of the time it's accurate.
Okay.
So, but going back to the fact that when a buyer's like, look, I got 5% to put down, you could say, awesome, we can put down that 5%. And then we could ask the seller to pay 3% of the sales price towards your closing cost.
Mhm.
And if they pay 3% of the 4%, then the buyer just needs to come to the table with an extra 1% of the sales price. Or at that point, they could say, you know what, maybe I'll just put down 3% rather than putting down 5%
Mhm.
and keep an extra 1% in my pocket.
Right.
So, you know, but those are just quick realtor facts that's easy for you to rattle off.
Okay.
Any other questions as it relates to closing costs?
I've had the question early on in my career. What encompasses the admin fees for the realtor admin fees?
Oh, just what do you mean? Like, the admin
What-
fee? Like,
What is it? Yeah, what is it? What are you paying for?
I think that's a question. I mean, I would have a conversation with the broker on that, you know, but I definitely understand that. You know, when somebody asks me, what's the purpose of that fee? I say, look, legally, they're supposed to keep your stuff on file. And frankly, you're also paying to use their services, it's just like when you go to the dealership, right? You have the dealership fee. It's the same exact thing in a sense. How's your rebuttal on that? How's your answer on that one?
Something similar, like storage
Yeah.
fees and transaction fees,
Yep.
pretty industry standard, but coming from somebody who hasn't purchased a home in about 20 years and in a different state altogether, it's just it's a topic of
Oh yeah.
yeah.
Yep. And then the other thing too is like, well, keep in mind on a FH or on a VA loan, you are not legally allowed to charge the realtor admin fee.
Okay.
The VA administration will not allow you to charge the admin fee.
Oh. Probably, and that's probably where her contention was, because her first loan was a VA loan, so she's basing everything off of.
So
how it
she's
used to be.
she's never needed to pay that. Now, why is she not getting another VA loan?
Because she still had the first home. She still owns the first one and paying mortgage on it. So this is her second home. So VA loans, you are not allowed to have more than one home underneath the VA loan? No?
Mm-mm.
True.
False. So you are able to have multiple VA loans at the same time. Obviously, the VA loan has to be your primary residence, right?
Right.
And in addition to it having to be your primary residence, you have to make sure you have enough eligibility left over in order to buy another one. So what I would do is order their certificate of eligibility from the VA administration, right? Like I would get their social, date of birth, and branch military,
Mhm.
and order their certificate of eligibility from the VA administration and determine whether or not they have enough eligibility to buy again with a VA loan. Another option too is they could refinance their existing property out of VA into conventional because the market has gone up in value, that they don't need to do 100%, right? So we could refinance their existing home into a conventional conforming mortgage, free up their eligibility and title in the whole amount, and then finance 100% of the new home. So that's certainly an option with a VA loan. But yeah, that's a big misconception on a VA product. Everybody's like, well, I only could have it once. Not true. You could have it multiple times. You could have a VA loan multiple times, and you could have many VA loans at the same time. But are you going to be able to finance 100%? Is determined by your eligibility, how much is left over. So is that an active client?
No.
Okay. So, but yeah, that's something to consider. And then throughout this booklet just goes over like what documents you're going to need. I've included like a little home buying process, because honestly, a lot of people that are, doing this are first time home buyers and they don't necessarily understand the whole process
Mhm.
yet. So, even though this is a little confusing, it's a little, Monopoly game of how to get to your house.
Sure.
Obviously you're going to guide them, him or her, through the whole process anyway, but this is a good thing for them to refer back to. One of the big things that they get at the end of the transaction is what's called the closing disclosure. And obviously we have to send that out 3 days before they close. So I never want them to see a sample of a closing disclosure for the first time 3 days before signing their
Okay.
actual loan. So this is a sample of a closing disclosure so people understand what they're getting themselves into.
Gotcha.
And then here's what's interesting, right? Like with rates as low as they are right now and what's going on in the marketplace,
Mm-hmm.
I would use like right now, like 3.125 is a good example of where rates are. Let's pretend somebody's buying a $210,000 house. That's $900 a month, or not house. I'm sorry, borrowing $210,000. It's only going to cost him or her $900 a month to get a loan. Now they have to tack on their homeowner's insurance and taxes and potential mortgage insurance. But the principal and interest payment is only $900 a month in order to borrow $210,000. So when people are like, oh, like, I really don't want to go 200 is the max that I want to do. And it's like, well, why do you want to only borrow $200,000 when maybe your dream home is going to be closer to the, 230 price point? Well, I don't want to go so much in that. That's way too much money. And I don't want to afford. Yeah, I can't afford that extra $30,000.
Right.
When you talk to somebody and you're like, look, the extra $30,000 is $115 a month. I'm not saying that's minimal, but that extra $30,000 could be the difference between moving into a house that needs work and moving into a house that doesn't need work. So when you look at that and you break it down with a client, they really like, it's eye-opening to them.
Mm-hmm.
So again, this has got samples of up to $450,000 in here. So, and then a little house hunting booklet and, how to apply for a mortgage.
Okay.
Any questions as it relates to all that information right there?
No.
Okay, cool. Have you, let me see the other thing that I got here. So in here is a realtor reference guide that I usually send out to realtors. Okay.
Mhm.
Hence the realtor reference guide. And in this realtor reference guide, let me see if I could zoom in here. And I'll get a cleaner copy here, but it talks about, like, again, the payment calculator and different things. And then in addition to that, it gives you a breakdown of the seller contribution that you could ask on different types of loans, primary residence, second homes. And then, what's really the kind of the max debt to total income ratio they like to have on different types of loans, conventional, FHA, USDA, and VA. And then the other big question is, a lot of people are like, look, I had a foreclosure in the past. Can I get another loan? And the answer is, if you had a foreclosure, you can get an FHA loan 3 years after the completion of the foreclosure, right? I had a bankruptcy. How long do I have to wait before I could get a loan? This is an awesome little guide that I give to every one of my agents at the beginning of the year. And I recommend that you take a picture of it and save it in your favorites on your iPhone so that you could reference it when somebody goes ahead and asks you what's going on, or your phone, and save it as a little in an album, because it's super helpful.
Okay, so that's not included in the other guy that you're going to send me?
It's not, no. And I'll email you this too, though.
Okay, please do. Thanks.
Oh, that's my wife.
Hey, wife.
All right. So then here's the other thing too that we do is we do a lot of renovation loans. Are you familiar with like the FHA 203K?
203K, yeah.
Yep. So we're awesome at that. We got a great product with an FHA 203K. And I always tell people, and we also have a conventional product, which is the same thing as the 203K, right? We allow you to do the buy the house for whatever price, roll in the renovation cost. And, we'll give you a loan based on the total acquisition on either one of those situations. So there's a limited 203K, which says the work, can't exceed $35,000. And then there's an FHA 203K that you could do $500,000 worth of renovations to the property. Again, awesome, awesome, awesome product. I personally did an FHA 203K, lived in it for a few years, sold it, and made a bunch of money, right? It's a great way for your buyers to build instant equity. And it's also a great way for you to no longer drag around a buyer that's very specific to a certain area, but doesn't like the fact that grandma, hasn't updated her bathroom in 40 years. You could roll the renovation into the loan. So it's another way for you to sell outside of, hey, this house, is perfect for you. You could say this house is perfect for you, other than this outdated kitchen and this outdated bathroom. But I have an awesome lender that will be able to go ahead and roll the purchase and the renovation into one loan, and then we could finish a job.
Okay.
The buyer cannot do the work themselves. They have to use an MHIC licensed contractor, and the work must be completed within 6 months.
Okay.
So I'll send you information on that. The other thing that I want to see is, have you heard of what's called the Maryland Mortgage Program?
Yes.
So the Maryland Mortgage Program is an awesome product. Did you ever do a Maryland Mortgage Program loan?
Yes.
Which one?
My lender just calls it MMP, and he doesn't
Yep.
break it down any further than that.
Okay. So there's a bunch of different Maryland mortgage programs, right? One of them is called Smart Buy,
Mhm.
which allows the buyer to pay off $30,000 worth of student loan debt into the transaction, which is pretty incredible.
Mhm.
And the deal is, though, the only deal is you have to pay off all your student loan debt at the time of settlement. So if they have 60 grand in student loan debt, they got to come to the table with $30,000, which, if somebody has 60 grand in student loan debt, they're not going to do this program. But if somebody's got $30,000 or $25,000 in student loan debt, they may do this program, because at the time of settling their loan, they will go ahead and get debt. They will become, they will own a home, and they will become student loan free.
Up to 60,000,
Up to
30,000.
30 grand. Yeah.
Because 30 is what they're giving.
The state will give you $30,000 to wipe out all your student loan debt. But the deal is all your student loan debt has to be wiped out at the time of purchase. So, it works really good with somebody with $30,000 in student loan debt, because they have no more student loan debt left. It's a really awesome product, and it's a really good way for you. Like, look, I hate to say it, Facebook is an avenue for you to market on, right? You could, write in there, hey, I just had an awesome discussion with a local lender talking about how you could buy a house and wipe out student loan debt at the same time. Call me for more details, right?
Sure. Mhm.
And then your phone will start ringing, because everybody that was student loan debt's like, oh, I want to buy a house, but I've been hesitant to buy a house because I want to pay off my student loan debt or get it more under control. Well,
Right.
again, this product will wipe out $30,000 worth of student loan debt, which is pretty awesome.
Okay. Gotcha.
And that's through MMP, the Maryland Mortgage Program.
Mhm.
There's another one called 4% Flex, which we could go ahead, like I'm doing a loan for a buyer. She's buying a $200 and something thousand house. She put $2,000 down as her earnest money deposit, and she's actually getting a check back at closing for $1,300. So in theory, she's buying a $200,000+ home and only coming to the table with $700.
Mm.
Because we're doing what's called a 4% grant. We're giving the buyer 4% of the loan amount in the form of a true grant that is fully forgiven,
Mhm.
which could be used for down payment and closing costs. So they're coming to the table with no money to buy this house. And, you know, she was paying $2,000 a month to rent. Her new mortgage payment's gonna be $1,500 a month. She just didn't have the funds for down payment. So we structured it with this product and program, and she's doing backflips, her and her 3 kids. So, you know, it's an awesome, awesome product.
Okay.
But yeah, I mean, that's kind of the gist, man, is like there's a bunch of different loans out there with regards to, it's not your job to understand every single one of them. Obviously, it's my job.
Yeah.
However, it's my job to give you enough tidbits of information for you to kind of dangle that carrot in front of the buyer and
Sure.
say, go talk to John now.
Right, right.
So, and that's what we do really well at our team. You know, we'll go ahead and work with the buyer. We'll walk them through the whole process. I always tell people it's never too early to be pre-approved. And we'll work, you know, we'll work with them. I will tell you, I'm not going to go ahead and lie to you and tell you, hey, we build people's credit. We do that, because that's, any lender that says that to you is blowing smoke, right? What we can do is we can help somebody's credit, but I'm not a credit repair agency. My job is to really just guide you and help the buyer qualify. So what we'll do is we'll work with the buyer, determine what we could qualify them for, and then obviously hand it back to you. You being relatively new, I'm not going to say new because you're newer, right? Obviously you've had some closings, which is awesome. But what we can do, and what I encourage us to do, is sit in, like for your first few deals, to sit in and have a meeting with me and the buyer so that you could understand the whole process better.
Right.
And I always use this example. I work with this agent, you know, he was a chef before becoming a real estate agent. His first 5 people that he ever sent to me, he sat in on those meetings so he could understand my job better.
Sure. Yeah.
And now he's closing $25 to $30 million in real estate. And he is able to tell the buyer what to expect, and, you know, to stand in our corner better than most agents because he understands our perspective. So if you've got the time, that's what I would encourage you to do.
Okay.
Assuming the client's comfortable with that.
Sure, sure. That's good to know.
Yeah.
One question I do have is, so say you have an interested buyer that's not really ready to purchase, but you want to lock them in to the current interest rates, and rate, you know, historically rates are so low where we want to get you locked in.
Mm-hmm.
How does that really work, and how long can they be locked in for?
So we have a product where we could lock somebody in for 180 days. But the
Okay.
longer we lock somebody in, the worse the interest rate is. So if you lock somebody in for 15 days, you're going to get a better interest rate than if you lock somebody in for 180 days.
Okay.
I would not encourage you. Look, interest rates are certainly an impact in having somebody qualify for a mortgage, but it's not detrimental it's not as detrimental as the media and everybody makes it out to be. Like for a $200,000 loan, the difference in 1/8 of an interest rate is $13 a month.
Mhm.
If $13 a month is going to make or break somebody from qualifying for a mortgage, full disclosure, they probably shouldn't be buying a home. So I always tell people interest rates are definitely important, but it's not the driving factor of when you're getting a mortgage or buying a house. What we have to do is you need to talk to a local lender that understands the concepts and is going to structure a loan that's going to fit your needs. Interest rate is always going to be up or down. You know, you need to structure a file that's going to fit your needs. So
when you hear the verbiage, you know, let me lock you in at an interest rate, you're really not being locked in at a particular rate because you said it's still going to change.
Well, you're locked into an interest rate. So the verbiage in regards to before you find a house, or just in general, like when we lock somebody in, so like if they found a house, we're going to lock somebody into an interest rate. But I don't
Right, so
want to lock.
if they haven't found a house, but they want to take a benefit of the current interest rate. There's no way to lock them in at that current interest rate, even though they don't have a home.
There is, but the problem with doing that is we don't know when they're going to buy. Are they going to buy 180 days from now, or are they going to buy 30 days from now? Because if I lock them in for 180 days, because that's what they initially said, they were going to not find a house for the next 6 months.
Hmm.
And then they find a house and they want to close in 30 days. They're actually going to get a higher interest rate, because the longer we lock, the higher the interest rate is. Because what
Gotcha.
we're doing is we're pulling that money off the market.
Mhm.
Look, there's online companies that will tell you, hey, you could lock in now at a low rate and this and that. And there's companies that will present that option to people. Again, it's just a gimmick to get people in the door.
Okay.
It's not something that I would encourage, it's, in my opinion, if you're just selling interest rate as a loan officer, then you're actually not a good loan officer.
Right.
Because interest rates go up and down, and you're never going to have not one company is ever consistently going to have the lowest interest rates.
Gotcha.
What we want to do is structure a loan that's going to be best suited to that client's needs.
Mhm.
And, is it going to be the Maryland Mortgage Program where we're going to pay off student loan debt, which is a higher interest rate than the market? But the advantage is you don't have student loan debt,
Right.
So it really, I would discourage, like, that's the biggest mistake new agents make is say to their clients is preach interest rate and, say, oh, go to this guy, or, find the guy with the lowest rate. It's not what you should do, because at the end of the day, I'm holding your commission, right? Because if I can't close the loan, you don't get paid. So you need to say, look, you've got to talk to my mortgage guy, because he is going to go ahead and structure the best loan for your needs.
Mhm.
And that needs to be your sales pitch and your referral to the loan officer, rather than simply being like, oh yeah, let's rate. Because unfortunately, the consumer just hears rate, but what they don't understand is the importance of actually qualifying.
Okay.
So the other thing too is, like, the best way to refer people to me, right, is to connect them with as an email. Say, Mr. and Mrs. Smith, this is the lender I was mentioning on the phone with you about. He's awesome. Hey, John, CC'd our Mr. and Mrs. Smith when you have an opportunity to reach out. I go ahead and send them an email, and the email that I send to them is going to be, let me see if I can share this. Full disclosure, it's a template email, which makes my life easy. Mr. and Miss, thank you, realtor, so it'd be, thank you, Brian, Mr. and Mrs. Smith, as Brian mentioned, my name's John Wall, and I put in what they're trying to accomplish.
Mhm.
A little video to the home buying process, kind of what we just went over. This is an awesome site. It goes into, like, different neighborhoods. So if you're like 21286, right? If that's the neighborhood you're looking at as a buyer, enter address. Let's do 135. If you're a buyer, right, you could type in an address and find out any area information on the on that particular area, like recent sales. And again, it doesn't take away from your Bright or
You may
MLS,
already know some facts and figures
but
about this
it gives you a
address,
kind of
but how
cool
much do you-
situation, and it gives the buyer an idea of, like, what are the people there, what's the population, all the public information. So, I mean, at the end of the day, like I said, is our goal is to capture it and build a specific situation to the client and communicate with you constantly. So,
Gotcha.
and I would love to gain any of your business if there's an opportunity. Obviously, you're the only one on here right now. So if there's any way that we could, work together, that would be my goal. And so.
30 grand more.
But any questions or anything that you want to discuss right now?
No, that's a really good overview. I appreciate it. Do you need my email address to
Yeah.
send off?
I would love it. And what's your email?
bhall 591971 at Gmail.
I just want to send a test right now,
Cool.
and then I'll send you an email breaking all this down.
Okay.
And then, look, give me an opportunity at your next client. I would love to kind of help them and see what we could do. And if you want to sit down and meet with me further, I'm happy to do that. Other thing I didn't address right now is that we do have a marketing team. I don't know if you've been to the office or not. But here am I, marketing. So we have a marketing team at PureMI that will help you with your marketing needs.
Okay.
And like, here's examples of like different things that we do for clients. Like I did a whole pumpkin drop off, but it's based on Brian Buffini and all these different referrals. Like, our competition, doesn't measure up, so it would be just, simply your information on here and a way for you to kind of just market to your sphere of influence.
Okay.
So if it's something that you're interested with, I would love to shoot me an email back, and I would love to go ahead and have a conversation with you and our marketing team on how we could help your business grow. And that's really the whole purpose of our marketing team.
Got you.
So,
Okay. For now, I look forward to that whole guide.
yeah, absolutely. I'll shoot that over to you in a little bit.
And where do you physically sit?
So I sit in the Keller Williams office, once or twice a week in Lutherville. I have a New York number. I grew up in Brooklyn, moved out to Westchester, never changed my number. So that 914 area code is my cell phone. But I actually live in Timonium area, Lutherville, Timonium area. So
you're in the Lutherville office, not the Legacy office.
Yeah, that's a Legacy office. I sit there about once or twice a week.
Gotcha.
And then I have an office in Timonium myself where I sit at.
All right.
So, do you come into the office at all?
Yeah, I typically come on Wednesdays. That's our team meeting.
Nice.
Team
Which
meet day.
Which team are
I'm
you
with
at?
Angelo Cooper in the Coop
Oh,
group.
cool. Yeah. Nice, man. So,
Yeah, I'm coming there today, but not for a team meeting, but just to hang out with like-minded individuals.
awesome.
During COVID, everything was me sitting here on a regular basis, and
I know.
when everything opened up a little bit, I figured I need to get in the office as a means of networking and just, like I said, being around like-minded people and getting that energy, that realization.
I know. I think it's one of the biggest things that people miss, and like some of these offices are empty, and I'm like, man, we need to get back in it just for mental health purposes.
I'm actually going to a networking event tomorrow at a restaurant. Well, that's
cool.
That's the first time in my short real estate career I've been able to do that. So I want to take advantage of that.
Oh yeah, because you came in COVID, really.
Yeah, sure.
So,
all right, John, thanks for the info.
Yeah, absolutely. Shoot me an email back with your information, and then I'll send over all that, and we'll get rolling from there.
Okay, great. Thank you.
All right, take it easy, my man.
You too.
Later.